do you see the market at the moment? How does that impact Pakistan and emerging markets from your vantage point?
Yeah, this is really bad. Like, no one is actually, I don't think, quite aware of how bad this is. And people are still saying, oh, deals are getting done, deals are getting done. No, yeah, they are for the very best companies. Cram downs are very real. These markets are unprecedented, I think, in the last 13 years. And people point to, the brief few weeks we've had around COVID. I think this is like the first sustained prolonged downturn. And I think this is not even the start. I think blood will be on the streets in the next 6 to 12 months. I think probably really culminating in Q1. And I think it's going to get a lot worse. When I refer to that tweet, this knowledge isn't known by most founders who still think the markets are where they were last year. You cannot go out and raise your 12 million A on your 40, 50, 60, 70K ARR. It just doesn't work like that. I'm really sorry. And so my concern is I've seen a lot of companies go out with too big a request. Everyone go, no way. And actually, they probably would have done it if you were going for the 4 million seed extension, but the 12 million A is no longer possible. It might have been last year. It's not now. You've got to be plastic to markets. Like Katif said quite rightly on, investor mindsets and being plastic. Yeah. Founders have to be plastic and move with the funding environments. And I think that's crucial. And then I think, what does it do for Pakistan? I think wrongly, it makes life really, really hard. Right. And this is what I think is very sad, because actually now's the best time to be investing, ironically. Like, it is literally the best time. But I think it makes it hard. I think investors retrench back to domestic markets. They retreat to safety. And I think, where's it challenging? It's challenging at growth, where prices are higher. And it's challenging in businesses that have more strained unit economic models and are in emerging markets. And so I think it's the best time, but I do think we'll see a retrenchment from all the big players we saw moving back away from emerging markets, sadly.
So we've got a ton of founders who are watching this. What advice would you be giving them in terms of positioning with that realization?
Cash conservation, business model optimization, extension of runway. Survival is the new success. Like, nothing lasts forever. This too shall pass. But right now we're moving close to the eye of the storm. And I think a much tighter focus around unit economics, a movement towards profitability as much as possible, and actually being aware, I hate founders shaping their business for VCs, but being aware that a focus on growth is no longer what VCs have, but unit economics, contribution margin, and a sustainable revenue generating business is where VCs are heading. So that's where I'd position my mindset as a founder today and show a pathway to that if I'm going out to raise now.
And you want to see that in the pitches that you see and with your portfolio. Is that a fair assessment?
Yeah, it is. Absolutely. Okay. I want to see the levers that we can pull to get to profitability. And then, let's see how probable they are. Okay. Yeah.
That's good. Adif?
Yeah, so it's a complete mindset from 6 months ago. I think that path to profitability is very, very, very clear. Now, if you're a founder who's just starting today, actually, this is a great time to start, right? Like, maybe you won't raise a 2 million seed round, you'll raise $1 million. It doesn't make much of a difference, to be honest. You'll just build slower. And by the time, you are ready to really scale, we'll hopefully be at the other end of this market. But anybody, if you've been around, and especially in emerging markets, Harry is right, they unfairly get the, long end of the short end of the stick. And those are considered high risk. So that entrenchment first happens in emerging markets. It affects, growth stage companies more. So I feel like that's the red zone where you have to be really, really careful. And doing everything you can to extend that runway to 12 to 18 months. I think that's the most important thing. Bring in more cash, cut down on expensive, figure out, how to change the business model to have that path to profitability. And on that, I think we don't want to be slow. You don't want to say, look, let me see another 2 months and see how the market trends. I think if you have to make those changes, the sooner you do, the better, and adapt to that changing market and hunker in for the long run. And, again, a year from now, we might be in a very different market, and that would be the time to then again change your strategy and go big.
Yeah, I'm so with you. It's such a good point, Atif, on like now being the time, not next month, not 2 months, like now, and being very, very diligent around execution. I think the other thing is like in the US, there's a lot more fear of running out of cash, it would seem, actually, from the founder perspective, which is maybe, yeah, I didn't expect. Like US, when they hit 6 months of runway, they're out pounding the pavements fundraising. Often I'm meeting emerging markets founders and I'm saying, what is the cash profile looking like? How much do we have left? And they're going 2 months. And I'm going, wow, that's a 20, like you're going out to raise a 20 to 50 million round. Even if I sign today with legal transactions, you may not get cash. Like you fundamentally have leverage when raising, and the less time you have, the less leverage you have. And so 2 to 3 months is not okay for going out to raise.